These 3 covered call ETFs portfolio will surpass your full-time job. Imagine turning a $10,000 investment into $18,000 per month in passive income. No boss, no 9 to 5, just financial freedom. Sounds impossible? Not with covered call ETFs like JEPQ, XYLD, and QYLD. These ETFs use a powerful strategy to supercharge dividend yields up to 12% and turn a small investment into a cash flow machine. Today we're breaking down how the covered call strategy works and revealing 3 of the best ETFs that use it to maximize returns. With just a $10,000 investment today, you could build a portfolio that pays you over $18,000 per month in passive income. Sounds impossible, right? By the end, you'll see how this simple investment approach could out-earn your full-time job and set you up for financial freedom. Stick around, you won't want to miss this. What are covered call ETFs? Imagine owning a portfolio of stocks, often from major indexes like the S&P 500 or NASDAQ 100, and getting paid extra just for holding them. How does this work? By selling call options on those stocks. Think of a call option like a lottery ticket for traders. They pay a premium up front for a chance to buy the stock at a set price. If the stock rises above that price, they can cash in. But here's the best part. No matter what happens, the ETF collects those premiums and passes them on to investors as dividends. Pretty sweet, right? That's the power of covered call ETFs. The trade-off? While these ETFs generate consistent income, they also cap their potential upside. If the market soars, the ETF doesn't capture the full growth because those call options limit gains. But for investors who want steady cash flow rather than chasing stock price increases, covered call ETFs can be a powerful tool, kinda like turning a portfolio into a monthly paycheck machine. Now, let's get to the first ETF. QYLD. This is the Global X NASDAQ 100 covered call ETF. This fund is like a blend of tech-savvy investing and income generation. It holds stock from the NASDAQ 100. Think big names like Apple, Microsoft, and Nvidia. QYLD is heavily invested in the technology sector, with approximately 48.67% of its holdings in tech companies. This focus includes major players like Apple, Nvidia, and Microsoft. Beyond tech, QYLD allocates about 17.07% to communication services and 15.25% to consumer cyclical sectors. This sector distribution emphasizes its focus on technology and other growth-oriented industries. For its strategy, it generates income by selling call options on these holdings. This strategy brings in extra cash through premiums, which is then passed on to investors as dividends. QYLD sports a dividend yield of about 12.38%, meaning for every $100 invested, you'd get around $12.38 annually in dividends. Over the past year, the fund has delivered 4.23% in price appreciation and 11.41% in dividend growth. The fund's expense ratio is 0.61%, which is the annual fee taken by the fund managers. In a nutshell, QYLD offers a way to tap into the tech sector's potential while enjoying a steady income stream, though it comes with some limitations on growth due to its covered call strategy. Now, if you start with a $10,000 investment in QYLD, let's see how much this can realistically grow over time. After 5 years, your portfolio has more than doubled to $22,000 thanks to reinvested dividends and price appreciation. Your annual dividends are now around $2,400. This is starting to feel like a solid side income. Now let's jump ahead to 20 years. If you stay patient and keep reinvesting, your portfolio could be worth nearly $239,000. More importantly, your dividends would be around $26,000 per year, or about $2,200 per month. That's enough to cover a lot of bills, maybe even your rent or mortgage. But the real magic happens at 30 years. With compound growth and consistent reinvestment, your portfolio could balloon to a massive $1.2 million. Your dividends? A jaw-dropping $129,000 per year, or around $11,000 per month. That's more than most full-time salaries, all from an initial $10,000 investment and the power of compounding. That steady cash flow makes QYLD a tempting choice for income investors. But what if you want a mix of high dividends and some potential for growth? That's where our next ETF comes in. XYLD. This is the Global X S&P 500 Covered Call ETF, and this fund aims to provide investors with consistent income by holding a diversified portfolio of S&P 500 companies and employing a covered call strategy. In terms of its holdings, XYLD mirrors the S&P 500, encompassing a broad range of sectors. This includes technology giants like Apple and Microsoft, financial institutions, healthcare companies, consumer goods, and more. This diversification spreads risk across various industries, providing exposure to the broader U.S. economy. Comparing XYLD to QYLD, the key difference lies in their sector focus. While QYLD is concentrated on the NASDAQ 100, which is heavily weighted towards technology and growth-oriented companies, more than 48%, XYLD encompasses the entire S&P 500, offering a more balanced sector distribution. This means XYLD includes sectors like healthcare, financials, and consumer cyclical, which are less prominent in QYLD's portfolio. As a result, XYLD may provide more stability and sector diversification compared to the tech-heavy QYLD. Now let's talk numbers. XYLD boasts a dividend yield of approximately 11.53%, meaning for every $100 invested, you'd receive about $11.53 annually in dividends. Over the past year, the fund has delivered 5.95% return on share price and 20.94% dividend growth. The fund's expense ratio is 0.60%, which is pretty decent. Let's put these numbers in a perspective and see what happens if you start with a $10,000 investment. By 5 years, things have already started to compound. Your portfolio grows to $23,000 with annual dividend payouts of $2,000. That's enough to cover a few bills or a fun night out every month, all from an investment you made years ago. Jump to the 20-year mark, and the numbers get exciting. Your portfolio could be sitting at a solid $273,000, generating a passive income of over $27,000 per year, or $2,000 per month. That's more than enough to cover rent or even replace a part-time job. But here's where the magic really happens. 30 years in, your portfolio could be worth over $1.43 million. And the dividends? A massive $146,000 per year, which breaks down to about $12,000 per month. That's a full-time income, completely passive, just from an initial $10,000 and the power of compounding reinvested dividends. Compared to QYLD, XYLD has a slightly lower dividend yield, but it offers a bit more long-term portfolio growth. Ready to go even bigger? Let's look at JEPQ. JEPQ is the JP Morgan Nasdaq Equity Premium Income ETF. This fund focuses on major players in the Nasdaq 100, such as Apple, Microsoft, and Nvidia, aiming to provide investors with a steady income stream from the covered call strategy. JEPQ and QYLD may both track the Nasdaq 100, but their sector allocations set them apart. JEPQ is heavily concentrated in tech, with a whopping 50.33% of its holdings in the sector, making it more dependent on the performance of big tech companies. QYLD, on the other hand, takes a more diversified approach, with tech making up 48.67% of its portfolio. It provides a balance between growth and dividends, offering more stability during market downturns. In terms of performance, JEPQ offers a dividend yield of approximately 9.47%, meaning you'd receive about $9.47 annually for every $100 invested. The dividend also grows at 8.84%. Over the past year, the fund has delivered a price return of around 10.60%, which is impressive for the covered call ETF, which usually has limited upside. The fund's expense ratio interestingly stands at 0.35%, which is lower than others. Now, let's see what happens if you put $10,000 into JEPQ and let time do its thing. In 5 years, your investment has already gained momentum. The portfolio value climbs to $25,000, and your dividends grow to $2,000 per year. That's some solid extra cash flow. And at this point, reinvested dividends are starting to do some heavy lifting. Now, at the 20-year mark, things get serious. Your portfolio is now worth a massive $411,000, and your yearly dividends hit $33,000. That's about $2,800 per month, which is more than enough to cover most living expenses. At this point, your initial $10,000 investment has transformed into something that could replace a full-time income. But let's look at the 30-year projection, where JEPQ really shines. Thanks to its balance between high dividends and price appreciation, your portfolio skyrockets to $2.6 million. Your annual dividend income? A jaw-dropping $214,000, or about $18,000 per month. That's more than enough to retire comfortably, all from $10,000 investment and the magic of compounding. JEPQ and XYLD both generate strong passive income, but the real difference is in their growth potential. While XYLD offers a higher dividend yield, JEPQ shines with nearly double the price appreciation, 10.6% versus XYLD's 5.95%. That's a big deal because covered call ETFs typically trade off long-term growth for income. The key takeaway? JEPQ isn't just about collecting dividends, it also builds real wealth over time. If you want reliable income and a portfolio that keeps growing for the future, JEPQ stands out as a smart choice. We get it. These numbers sound almost too good to be true. But covered call ETFs aren't magic. They're a proven strategy used by professionals for years. The best part? You can start small, watch the dividends roll in, and see for yourself. Because real financial freedom isn't about working harder. It's about making your money work smarter. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.